Okay, we're recording. Hi, everyone. May 12th, 2021, and I'm joined by returning guest, Kevin Nichols. Kevin is the managing director of Penumbra Solutions. Penumbra Solutions creates life settlement investing funds. They are currently accepting investments for their 10th fund. So welcome, Kevin. Thanks for joining us today.
Thanks, John. Appreciate the opportunity.
Yeah. So I'm going to try my layman's term here on what life settlements are about, and maybe you can correct me, Kevin, if need be.
Sure.
So basically, you invest in permanent life insurance policies. You pool a number of these together into a fund that then you put out to the market, and investors can come along and submit their money and have it be money that they're willing to have, out of their control for, 5 to 10 years type of thing. And they can expect, lack of volatility. And so some stress-free investing, maybe low double digits, that type of thing. I got this about right?
That's pretty close. Yeah.
That's pretty close.
That's very close. The funds are what is known as a pooled investment, where investors come together and form a pool, a pot of money. And that pot of money we use to purchase life insurance policies from very, very old people who no longer want them, need them, can afford them. And we give them more than the cash surrender value in every case. Many of these don't have a cash surrender value. There's no value, in terms of a cash surrender in the policy. There's no cash buildup. So it's always a better option for them than simply lapsing the policy. 95% of all life insurance lapses, and so if you're an insurance company, that's a pretty good bet. You're gonna issue a lot of policies. You issue thousands of policies, and knowing that you'll only have to pay out on anywhere from 5 to 7% of them. Most policies lapse inside of 7 years. And the policies that we focus on, the insureds on these policies, the underlying insured, the average age is over 92 years old. So you're talking about people that have had a long life and probably are, in the home stretch. They don't have a lot to go. The thing is, when people get that age, the policies become very, very expensive. The premiums become very, 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 very high, very onerous. And so when we take these over, we have to reserve for premium expense, of course. But what it does is if a 92-year-old is healthy, how long will they live? Well, 95, 97, 98, not too many people go beyond that. So on average, we're looking at policies that we expect to mature inside of the next 5 to 7 years. Right. So we just have to choose wisely, and it works out very nicely. The key for us is, finding the right fit. Most what we do is a little bit different. It's certainly not, we're not the only company in this space, although I would say we're probably the only company who specializes in very, very old people. Most firms stay away from these because you have to reserve so much money for premium expense. Most companies can't afford to do that. We, on the other hand, are a boutique firm, and we have no problem doing that. And so we're able to kind of slip between the big ships and pick up the policies that we want. And we really don't have a lot of competition for them because some of the major players that are other institutional investors that are literally billion-dollar funds, it's just not in their wheelhouse. They'd have to reserve too much capital. And when they do that, they aren't able to earn money on buying more policies. That's how we earn money, is by buying policies. And so because our overhead is so low, we're able to find a niche for ourselves that works very nicely. Additionally, if you're buying policies on people that are 78 to 82, you need to have a good idea what the life expectancy of these people is. And while we do get life expectancy estimates on every policy, we get 2 of them. Really, it's not the main focus. It's not it's not the only buying factor for us, because, like I said, in truth, if a person is 92 and healthy, how long will they live? Still not more than probably 5 years or so, maybe 3. So what we found early on is when we bought policies on people who were 78 to 82, when those life expectancies were incorrect, they seemed to be incorrect on the low side. In other words, they underestimated probably 2/3 of the time. And so those policies didn't mature in the time frame that we had hoped, and so the yields were lower. And so that's one of the main reasons we realized, or that we focus on older people, because it really takes that life expectancy estimate out of the equation. It's not such a burden, because we don't really care how long they live. They're not going to live to 110, most likely. I mean, the odds are they would not. So that's really our focus, is on the very old people.
Yeah, and that's part of the pooling, right?
Yes.
It's just like law of large numbers, in a
Absolutely.
sense that the larger the group.
Absolutely. Well,
Right. So if you do have the outlier, then you're still good, right?
Absolutely. Exactly.
Crush it.
We can always sell a policy if it approaches non-profitability. And we have before, we'll sell it off. And, we just didn't make anything on that policy. We've always been able to get our money back on the policies that we've sold. But yeah, we can always sell the policies off.
Yeah. So that does lead me into this question that I get from people when I bring up life settlement investment funds.
Sure.
They'll say, geez, why are they doing that? Why, that sounds like we're taking advantage of people, like, as if like the elderly are once again being taken
Sure.
advantage of, which is, all those stories.
Yeah.
But that we're not about that. This
Not
is
at all.
not what Penumbra is about. Yeah.
Not
Can
at
you
all.
talk a little bit about that?
Sure. And that's a common question. That, and isn't this a little bit morbid? Is also a common question, and the answer is not at all. Bear in mind that the majority of the people who settle a policy are, again, I said, over 90. They really don't need the policy. Most of them were purchased the policy 3 to 5 years prior for inheritance tax or estate tax purposes. In other words, they had a large estate. It was still in their name, and had they passed during that time, they would have had a large estate tax burden. And so they'll work with an estate planning attorney who will say, look, we're going to get rid of your estate by setting it up in various trusts or other vehicles. But in the interim, you're going to need, if you were to pass, you're going to have a big burden, and we're going to have to sell some of these assets that you don't want to sell. So by getting a large life insurance policy, anywhere from $2 to $5 million, that's there to cover or to mitigate that tax burden. Now, once they have eliminated their burden, their tax burden, in other words, they've given away all their estate, they put it into trusts, etc. They no longer have a need for this policy. Now, this policy is a very expensive policy because of their age, and so most of them don't build cash value. In fact, we don't want policies that build cash value. That's not what we're looking for, because those policies, while they definitely have a place in planning, for our purposes, they're too expensive. So frequently we will take a policy that is even a term policy, but it's a term policy that has what is known as a convertibility rider. And that convertibility rider allows the insured to convert it from a term policy to a universal life policy. Now, what's the main difference? Well, one, universal life policies, they're typically going to be a guaranteed renewable every year until age 100, 105, some of them to 120. But the converse of that, or the other side of that coin, is that the premiums are going to go up significantly. So we're prepared for that. And so before we buy a policy, we make sure that it has been converted to a permanent policy, generally universal life. We have purchased whole life policies in the past. It's not something we look for, but we have maybe less than, I would say, less than 5. And when we do have a whole life policy that has cash value, the first thing we do is we'll use that cash value to pay the premiums to lower the premium burden on the fund itself. So that's really what we're looking for is people in their 90s. Health is really irrelevant. We don't really care. But we want good, solid companies. All the policies that we buy are from American A or better rated companies. Since 1845, no American B+ or better rated companies ever failed to pay on a death benefit. And so we've never had a policy not pay us what we expect. We've never had an investor lose a dime. So we're very conservative about what we do and how we do it. But the bottom line is we have a fund that delivers, what we target is 10 to 12% annualized net of all fees. Our fees are unbelievably low, but net of fees. And that's what we deliver. Now, honestly, I think several of our funds are quite a bit higher than that, but we're not going to change what we're stating. It's
Okay.
10 to 12 is our target. And if we can under promise and over deliver, then that's a good situation.
Sure. To me, it's such a rock solid investment. I mean,
Mhm.
these things are going to come to fruition.
Right.
They're stress free. They're not volatile.
Right.
You're going in with these expectations that we'll have conservative returns of 10 to 12.
Absolutely.
Higher, but hey, if you got 10 to 12 and it was a solid
Absolutely.
deal, and you're really looking at money that you don't need for any reason.
Right.
Right.
It's long-term money. Probably 80% of the money in any of our funds is going to be 401k rollovers, self-directed 401ks, IRAs, Roth IRAs, trust money. It's long-term money.
Yeah.
Now that being said,
yeah, I think. I'm sorry to interrupt.
no.
I
was going to say, that being said, we do take cash investments as well. Just
okay.
regular cash.
Real cash. Yeah.
Well, not real cash. That's what we can't take.
Real fake cash. Yeah.
There you go. Absolutely.
So yeah, that's a good segue. Obviously, we have a lot of people that are nearing retirement, entering retirement, but they may be leaving the workforce as things have shifted over the last year or so. People reassessing. They have 401ks. They still want some growth. They may want to roll it into a self-directed IRA. Do you recommend people go into a Roth? Do you recommend that they go straight to a self-directed IRA? Could you speak a little bit to that?
Sure. If someone is interested in converting their traditional IRA to Roth, I would encourage them to talk to us prior, because there's a specific strategy that we can utilize to help save them 20 to 30% on their tax burden when they do it right. Now, if they do it wrong, it's not it's not going to mess anything up. It's just that they paid more than they need to.
Right.
Okay. So yeah, but typically the process is someone's got a 401k, they want to roll it over. And so, or an IRA that's at, pick any of the brokerage houses, and they'll have to open a self-directed IRA, and we do that for them if they want, or if they've got someone that they want to handle, their self-directed IRA custodian. They're welcome to use whoever they'd like. Then we will work with whomever, but they need to have a self-directed IRA custodian. Schwab, Fidelity, they won't do that because they can't make any money. They can't control the investment, ergo they can't make any money, so they're not going to do it.
Right. Yeah. So when I look at, hey, if you can potentially, as you're saying, save 20 to 30% on your taxes,
Sure.
rolling it into a Roth IRA.
Mhm.
I would say that you're significantly growing your money that will come out tax-free, right?
Well, yeah, it's a beautiful thing because here's
Yeah.
the situation. Here's how it works. If you were to take, let's say, for example, we had a fund and we raised $10 million. We would deploy that capital into the marketplace. And when I say the marketplace, I'm not referring to the stock market or the bond market or anything like that. I'm just into the market in general. We would start sourcing policies, looking for policies. And bear in mind that we don't go and find these people who have policies for sale. They raise their hand and say, hey, I've got this policy, that I don't need. If they don't have an attorney, we get them an attorney. We make sure that they are represented. Because of that, we've never had a beneficiary or a former beneficiary challenge any of the policies, and we own over 1,800 policies across the first 9 funds. So we will source the policies. And so if say we raise $10 million, what we're going to do is we're going to look to purchase death benefits in the range of roughly, say, $35 million. So about 3.5 to 1. That's about average for us. Now, bear in mind that to purchase that $35 million in death benefit, we're not going to spend all 10 million. We're only going to spend probably 6 to 6.5 million, because we're going to reserve 3.5 to 4 million, 35 to 40% of what we raise is held at Bank of Utah, who is our fund custodian. We don't ever touch a client's money. We don't even have access to it. So we're going to reserve 35 to 40% for premiums. But with that other 6 to 6.5 million dollars, we're going to get death benefit of roughly, say, 3 to 3.5 times the raise. So if an investor were to invest $100,000 into a fund that has a life expectancy of, say, be conservative, say 7 to 10 years, that's pretty conservative, and their money was going to go from $100,000 to $300,000 in that period of time, having never been exposed to the market, having never been exposed really to any risk. I can't say none because I can't say none, but
Nobody can say
don't
none,
know,
but
show me one. It's pretty safe investment. We don't lose sleep over, over what our money is doing. And I would tell you this: we invest right alongside your clients, your investors. We are across all 9 funds. My business partner and I, we are the largest investors in the funds. We're not the largest single investor in any fund, any one fund, but across all 9, we are. We originally set this up for ourselves and for my dad, my business partner Jim, his mom, and some family members and some high value clients. And but as with most good ideas, it just blossomed and took off. We used to do financial planning. We don't do that at all anymore. All we do is manage the funds. We don't have time for anything else.
sure. I mean, it's really right in line with, privatized banking that I do
Sure.
with my clients. It's this financial certainty,
Yes.
right? We're not taking huge risks, but we're getting really above average returns.
Absolutely.
And
Absolutely.
without that stress of volatility or the unknowns, we're really trying to bring it down to more of the knowns and give people some comfort, but also give them what they need, which is to grow their money.
Absolutely. Because most people, the time you turn 65, I don't. What is the average age for retirement now? I think it's probably more than 65, more like 70, even 75.
Probably at least 7. Yeah, I think it's 7.
Absolutely. Absolutely. And most people are not done growing their money at that point in time.
Well, yeah. And if we keep, it's funny because you talk about all the medical breakthroughs and, how people are living longer. But
Sure.
on a side note, I said, if you just stop smoking, which is, I think,
Right.
probably elevated the life expectancy, because everybody was smoking and everybody was dying in their 60s. But now, I mean,
Yeah.
really, without that, I mean, people easily, when the life insurance companies decided to redo their tables and came up with 121, they jumped from 100 to 121.
Right. Absolutely.
They know something.
Well,
They
and
know.
we use those tables. The valuation basic tables is what you're referring to, and we use those tables. Life insurance actuaries are probably sharper than even the CDC actuaries for the government. Yeah, and we use them, and that's it's a big factor in our decision making process.
Sure. So I do look at it as, you know, we want to continue to grow our money. It's not about, you know, hoarding money. It's about,
Right.
you know, protecting your life and future generations if need be. And, you know,
Well,
we'll leave it at that, you know? Yeah,
what I say is, look, this investment is not for all your money. It's only for the money you can't afford to lose. Um, it's a great investment for that. I do get a lot of questions from investors about the effect of COVID on the funds. You know, is that going to dramatically change the longevity of some of the funds? And the answer is no, not in the way that you might think, because remember we're dealing with very old people, and typically, if you had a grandmother who was 90 and in the COVID era, what would you do? Well, you'd probably get her if you could. You would probably raise the drawbridge, you know, fill the moat around her so that she was not exposed. And that's what we've seen happen. And so we have had really, from our standpoint, no impact from COVID on the overall life expectancies of the insureds in our funds.
sure. Sounds great. Hey, Kevin Nichols, the Penumbra Solutions investment concept called life settlements. Thank you so much for sharing all this knowledge. You know, I hope to send some folks your way. I'm
Sure.
going to put in the comment how people can check this thing out from a, you know, an arm's length. And then if they like what they see, they can reach out to you.
Sounds great.
And hopefully you can help some people.
Super. Appreciate the relationship with you, John. Have a
Oh,
great.
same here, Kevin. Yeah. Take care of yourself,
Yeah, we will.
but
Bye-bye.
have fun. But have fun. Take care.
All right.